So, you've probably seen the headlines. The housing market is sending some seriously mixed signals right now. One minute, things are looking up. The next, we're apparently stuck in a standstill. So, what is really going on? Well, let's get into it.
Okay, so our whole story today really kicks off with just one number, and that number is 6.06%. Now, on its own, it might not look like much, but this single figure just sent a jolt through the entire market. It created this flicker of hope, in a place where there hasn't been much hope for a while. So, what does it actually mean?
All right, so let's put that number into perspective. 6.06%. That's the new average for a 30-year fixed-rate mortgage. And get this, it's the lowest it's been in over 3 years. Now, think back to just a year ago. That same rate, it was over 7%. That is a huge drop. And believe me, it had some pretty immediate consequences. So you gotta ask, where did this sudden drop, this spark of optimism, even come from? This wasn't just the market waking up on the right side of the bed. Nope. It was triggered by a very specific action. Let's dig into what exactly lit the fuse. And here it is. The government stepped in and announced a massive intervention. They said Fannie Mae and Freddie Mac would start buying up $200 billion worth of mortgage-backed securities. Now, the goal here was pretty simple. Pump a whole lot of money and, just as importantly, confidence into a market that's been, well, pretty sluggish. So, the big question is, did it work? You bet it did. The market's reaction was immediate and it was powerful. It led to what we can only call an application boom. I mean, look at these numbers. For the week ending January 9th, that's right after the announcement, overall mortgage applications just skyrocketed. We're talking up 28.5%. And even the number of people applying to actually purchase a home jumped by a solid 16%. It's safe to say buyers and current homeowners were definitely paying attention. But wait, check this out. This is where the real story is. Applications to refinance an existing mortgage, they surged an unbelievable 128% higher than the same week last year. Just think about that. Homeowners who were stuck with those higher rates saw a golden opportunity, and boy, did they rush to grab it. Okay, so we've got lower rates, a flood of applications, everything's fixed, right? The market is saved? Well, not so fast. Because all this good news about rates runs headfirst into a huge, persistent problem, what we'll call the affordability hurdle.
Now, at first glance, there is more good news. The median monthly housing payment actually fell to its lowest point in 2 years, down to just over $2,400. I mean, that's down about 5.5% from a year ago, which sounds great, but that's only one piece of the puzzle.
And this is where we get a dose of reality from Hannah Jones, an analyst over at Realtor.com. She points out that even with those slightly lower payments, these affordability constraints are still a massive factor. Her big takeaway? Don't expect some sudden explosion in home sales. She says any recovery is going to be gradual rather than rapid. And this tension, this push and pull, really brings us to the core of what we're talking about today. A housing market that's basically divided against itself. You've got different signs pointing in completely opposite directions. It reveals a story that's way deeper and more complicated than you'd think.
Just look at the data from this past December. It's kind of wild. Pending sales, so that's homes going under contract, they were down almost 6%. Okay, but at the exact same time, existing home sales, deals that actually closed, were up more than 5%. So how can the market be slowing down and speeding up at the very same time? It makes no sense, right? Well, this quote from a Redfin agent, Allison Williams, really gets at the human side of all these numbers. She says buyers are being extremely selective. They just feel prices are still too high and they're willing to wait it out. It's this hesitation, this friction between sellers who are hopeful and buyers who are really cautious that she says has created a standstill in the market. And yeah, this standstill is not a new thing. To put it all into a bigger perspective, the total number of existing homes sold last year was just 4.06 million. That number matches the year before, and it's the lowest total we've seen since all the way back in 1995. So yeah, this market has been stuck in a really low gear for a while now. So that brings us to the million-dollar question, or I guess the multi-trillion-dollar question. Where do we go from here? What do all these confusing mixed signals actually mean for anyone out there trying to buy or sell a home? Let's take a look at the road ahead. Okay, so there are three major challenges, or headwinds really, to finding the market right now. First off, the number of homes for sale, the inventory, is actually shrinking again. It's down over 18% just from November. Second, that means the overall supply is critically low. We're talking just 3.3 months worth of homes available. And finally, price growth has slowed to an absolute crawl, up less than 0.5% from a year ago.
And this brings us right back to that expert forecast from Hannah Jones. She says if, and that's a really big if, rates can stay in this new lower range, she's projecting a modest improvement for the coming year. Notice that word again, modest. Nobody, and I mean nobody, is predicting a sudden return to that crazy red-hot market we saw before.
So this is the big question we're left with. Mortgage rates are down, finally, and that offers a real glimmer of hope. But with home prices still stubbornly high and the number of homes for sale incredibly low, is this one piece of good news really enough? Is it enough to finally break the housing market's long, frustrating standstill? That is the question on everyone's mind.